Have you ever wished you could just peek into the future? To see next month's sales figures or maybe tomorrow's stock price? Well, what if I told you that data can give us a pretty good glimpse? That's exactly what we're diving into today, the amazing world of forecasting.
So, that's the big question, right? How do we actually do it? We all want to know what's just around the corner. And it turns out, the clues are often hiding in plain sight, right there in the data of the past. Today, we're going to unpack the tools that help us find them.
And believe me, this isn't just some academic thought experiment. This kind of analysis is the engine humming behind critical decisions in almost every industry you can think of. From governments planning massive budgets to your favorite store figuring out how much inventory to stock, these methods are being used every single day.
To get us there, here's our game plan. We're going to start with the absolute basics, what a time series even is. Then we'll learn how to read the hidden patterns in our data. After that, we'll get into the tools, from the simple to the more advanced, and we'll wrap it all up with the most important lesson, how to pick the right tool for the job.
All right, first up, Section 1. Before we can even think about forecasting, we have to get a handle on the basic building block we're working with. So, what exactly is a time series?
The definition sounds pretty simple, but it's incredibly powerful. A time series is just a bunch of data points collected over time. But listen, the two magic words here are ordered and equally spaced. The sequence is everything, and the time between your measurements has to be consistent, whether that's every second, every day, or every year.
So what's our goal with this data? It really boils down to a two-step mission. First, we have to play detective. We look back at our historical data and try to find a meaningful pattern, the real signal that's hiding in all the random noise. And then, step 2, if we think that pattern is going to continue, we can project it forward to create our forecast.
Okay, so that leads to the next logical question. How in the world do we actually find these patterns? Well, that brings us to Section 2, and what is absolutely the most crucial first step in any analysis, learning to read what the data is trying to tell you.
Seriously, before we even think about touching any complex math or fancy models, we have to start right here. A simple graph of your data over time, a time series plot, is the single most powerful tool you have. It's like turning on the lights. Suddenly you can see the fundamental shapes and patterns you're dealing with.
Let's look at one of the most common patterns you'll spot, a trend. Take a look at this plot of the Dow Jones. You see all those little daily ups and downs, right? The jitters. But if you kind of step back and squint, you see the bigger picture, a gradual, long-term shift to higher values. That's the trend. Now, here's another big one, seasonality. Check out this chart of umbrella sales. See that repeating up and down rhythm? Sales go up, then down, then back up again, and this whole cycle repeats itself predictably over a fixed period of time. In this case, it's every year. That reliable, repeating pattern, that's seasonality.
Now here's a classic trip-up point for a lot of people. The difference between seasonal and cyclical patterns. It's easy to get them mixed up. A seasonal pattern happens within a single year, and it's usually pretty reliable. A cyclical pattern, on the other hand, plays out over many years. Think broader economic booms and busts. It's much, much harder to predict.
Okay, so we have spotted the patterns. What now? That brings us to Section 3, and our first set of tools. Think of this step like adjusting the focus on a camera. We're trying to clear away all the random, blurry noise so that the underlying picture, that real pattern, comes through sharp and clear. And the tools we use for this are called smoothing techniques.
The two most common ways to do this are with moving averages and exponential smoothing. The key difference between them is how they treat the past. A moving average is super simple. It treats every single past data point as equally important. Exponential smoothing is a bit smarter. It assumes that what happened recently is probably more relevant than what happened a long time ago, so it gives more weight to recent data.
So how does this exponential smoothing actually work? Well, it uses a setting called alpha, which you can basically think of as a memory dial. A high alpha means the model has a very short memory. It's mostly just paying attention to what happened yesterday. A low alpha gives it a long memory, where the distant past still has a pretty big influence. The key is that this influence always fades away exponentially over time. So, which one do you pick? Here's a super simple rule of thumb. If you plot your data, and it looks pretty flat, no obvious trend, no seasonality, then single exponential smoothing is your best bet. But if you spot a clear trend, an upward or downward slope, you need to upgrade to double exponential smoothing. It's built specifically to handle that.
But what happens when your data has it all? When it has both a trend and a seasonal pattern going on at the same time?
Well, for that, we need to bring out the heavy hitters, the more advanced methods designed for exactly this kind of complexity.
The two main approaches here are time series decomposition and something called ARIMA models. Decomposition is kind of like taking a car engine apart. It literally breaks your data down into its three core pieces: the trend, the seasonal pattern, and all the random noise that's left over. ARIMA is a more mathematical approach that builds a sophisticated forecasting model by looking at how past data points are related to each other.
Now, I know ARIMA can sound super intimidating, but the process for building one, called the Box-Jenkins method, is actually very methodical. It's a logical, step-by-step process. First, you stabilize the data. Then, you identify the right model structure. And finally, you check your work to make sure the model is actually a good fit.
You'll often see ARIMA written out like this, ARIMA PDQ. And I know, it looks like complicated code, but it's really just a recipe card. The P is the autoregressive part. It asks, how much does today's value depend on yesterday's? The Q is the moving average part, which helps correct future guesses by looking at past mistakes. And that D in the middle, that just tells us how much we had to stabilize the data to get started.
And what's so powerful about the ARIMA framework is just how flexible it is. As you can see here, you can add another whole set of parameters just to handle seasonality. This makes it an incredibly robust tool that can model even really complex data that has multiple patterns happening all at once.
So we've covered a ton of ground, from simple smoothing all the way to advanced ARIMA models. But that brings us to our final and honestly the most important section. After everything we've talked about, what's the one thing you absolutely have to remember?
It's this. More than any complicated equation or fancy algorithm, the success of your forecast comes down to one thing. You have to correctly identify the underlying pattern in your data first. The most sophisticated model in the world will give you garbage results if you apply it to the wrong kind of pattern.
You know, this quote from our source material just hits the nail on the head. It says it all. The pattern is everything. First, you have to understand the past. That understanding comes from identifying the pattern, and that pattern is what tells you exactly which forecasting tool to pick up.
We started this whole journey by asking how we can use data to predict the future. Well, now you have the fundamental tools to get started, from just plotting your data to choosing a sophisticated model. So the only question left isn't how anymore, it's what. What future are you going to predict?